Hello and welcome to the download. I'm your host, Dave Richardson, and we are joined by Canada's hardest working economist, Eric Lascelles. And Eric, you found out we were on video today. You're dressed a little different. Normally, you're sort of like in a tracksuit because you're sneaking in a workout while you're looking at charts and recording something because you're doing like 8 things at once because that's what you do when you're Canada's hardest working economist. But today, you look rather relaxed in your office, well dressed. You look
Thank you, thank you.
video worthy.
Believe it or not, the jacket matches the pants. That's not always the case when one's
Oh.
on video, but this is an actual suit, so feeling pretty good about it. Thank you, Dave. You're
Well,
looking good
just
too,
for,
by the way.
oh, thank you so much. I think do we kind of we actually almost kind of match, don't we? We should have checked that
That's
with
right.
producer Nancy. It's because we like to when we're talking economics, we like to put on the Economist team uniform, which is gray with a little blue or purple, whatever it might be, to because that really speaks. I don't know,
To our
dull
bland,
and
yeah.
dull, bland, whatever we want to call it. But uh, lot of stuff going on economically, and thanks for joining because this is another one where I just sort of flipped you a note quickly yesterday and said, could you pop on and discuss a couple of things? And the first is obviously we had an important meeting last week with the Federal Reserve getting together as they do once a year in Jackson Hole because it's a beautiful place. They're not in suburban Toronto. They're not around the corner from me in Mississauga. They're in Jackson Hole, beautiful place, and they discuss really important things, much more important than we're discussing right now, maybe. But I'm sure you follow that meeting very closely, and then what comes out of it. And is there anything that you cull from the commentary, the press conference afterwards that has you thinking differently about what they're going to do one way or another?
Uh, Great question. You're certainly right. Jackson Hole is a big monetary policy. What confab might be the word, and it's by the way beyond the Fed. You get central bankers from around the world who go there. The central purpose isn't usually to shock markets or to even directly. The purpose isn't even to signal to markets. It's to share insight and thoughts and research and so on. And so, of course, that's what most of it was about. But we did, as you mentioned, have Fed Chair Powell speak, and of course, that is an important thing to happen simply because the Fed hasn't cut yet. So many central banks have. The Fed has this big meeting, or could be a big meeting in September. And so the question was, will we get that clear signal of rate cuts to come? And we did. So I think that's the big takeaway. Powell explicitly endorsed, the time for action is now sort of thing. And so he confirmed, I suppose, absent, big surprises in the next few weeks that the Fed should start cutting. But he did so, I guess, in a sufficiently measured tone that and we were skeptical before as well, I should say, but in a sufficiently measured tone that I don't know that you could expect a 50 basis point rate cut. The market still got the chance of that. I haven't looked in a day or two, but it was like a 1 in 3 chance the market thought of a 50 basis point rate cut. I don't know if I see that. I mean, I can't deny that historically rate cuts happen pretty fast and so on, but the economy doesn't seem to be cratering as maybe for a brief moment in early August we thought it might be. And so, if a recession was here, you'd certainly be talking about bigger cuts. Doesn't seem to be. Happy to elaborate on that later if you want to go down that rabbit hole. But as it stands now, it was essentially a speech that suggested the rate cutting begins and we can start probably with a 25 basis point move, and seems reasonable to guess that there could be then some further moves at later meetings in the year. And so, not strictly, I should say, I mean, clearly endorsing rate cuts, not quite clearly endorsing the amount the market has priced. The market might be getting a little bit bold in the pricing, but nevertheless, just the fact that the Fed has now explicitly signaled made bonds feel pretty good, and made the market
Yeah.
feel pretty good on the risk asset side too.
And any thoughts too? So you're gonna the decision September 18th where they go
Mm-hmm.
either a quarter or 50 basis points. Their next meeting is I guess 6 weeks later, which is and the day after the election. The next great
Yeah,
decision. Does that timing play into it? Because even if they wanted to cut 50 basis points, you can go 6 weeks later. Doesn't make a huge difference. Then you may know who the president is the next day,
right,
and,
right.
and any
Yes.
policy changes that are coming, or at least the structure of U.S. government. So maybe you wait, and it gives you a chance to see how that plays out, and not get accused of trying
Right.
to move the needle on the election.
Yeah, so I guess when we're talking about beyond September, so into early November, I mean, to me, the most important thing is you will just have 6 more weeks of data, and you will know if the economy is reeling or fine, or if inflation is coming down or not. And I would think if the economy continues on its current trajectory, I would still bet on a 25 basis point move in November. But if it does decelerate or something else happens, then 50 is certainly possible. It is interesting. I've heard people argue, oh, no, you wouldn't want to cut. Right after the meeting, right after the election, rather, that would somehow signal partisanship or that you're. I don't know. They've been pretty clear through this. They're just kind of go when they think it's appropriate to go. In my view, that November meeting, and I think you hinted to this effect, is actually a pretty good time to be making some moves. Just because, I mean, here's the way I think about it. I think of it. You couldn't influence the election because the voting already happened, so that's attractive.
Yeah, yes.
You mentioned maybe we'll know the result. I don't know if we're going to know the result today. My recollection from the last few elections is we do not know the result the next day, and so you can't even argue they're sort of partisanly. Oh, now they're favoring the party that won by giving them this gift, and so actually it's sort of quite attractive to be cutting that. But I think again the best guess is just they will continue on a fairly smooth path, and so I would guess another 25 basis point cut then, and maybe another one in December, and of course they can pivot from there as needed.
As an economist, you would back up other economists when they suggest that they're just going to follow the data. There's no politics at all involved in it whatsoever.
Yeah, I mean, you're certainly saying that in a tone that suggests you have a degree of skepticism about that. Do the central bankers equally like both candidates? Probably not, since one sort of threatens their jobs, and so at a personal level, you might imagine that they do not have equally positive feelings toward both candidates. But I'm pretty sure they're just going to do their job and do what's best for the economy, and not actually change monetary policy in a way that reacts to. Well, I mean, I should say that reacts to which person wins. I mean, you can argue they should be, only in the sense that, of course, one might cut taxes, one might raise taxes, one might do tariffs. There's all sorts of interesting things that happen. You could argue, I think you could argue this, that a Trump win might argue for a little bit less rate cutting, just because tariffs are inflationary, and tax cuts could drive growth and things like that, and maybe the opposite. So maybe they should be paying attention to who wins, but they tend to do that in a pretty cautious way, and they tend to be, I mean, not totally reactive, but and this is true in Canada as well and other central banks, which is, they generally take the fiscal projection from some fiscal authority, and they don't try to get too cute in terms of projecting. And so I doubt the trajectory would be that different in the immediate months after the election.
I kind of asked that question for entertainment purposes only, but because I think, at least from my observation, I've been watching the Fed for a long time, maybe not quite as closely as you over your career, but it seems like they really are trying to stay with the principle, particularly in an election year, to following the data. The data is going to dictate what they do, and then after the election, once everything settles, and it is likely that we won't have a result the day after the election. I mean, it's very possible,
Mm-hmm.
and then you can see where who you have in the House of Representatives, who you've got in the Senate, who you've got in the White House,
Yeah.
and some kind of sense of the policy direction, and it would have an impact on your decisions from that point, because it would be a new data point. So you've got to
Correct.
factor that into the decision.
Yeah, exactly.
Now, Canada has a decision between now and September 18th. Is that a likely third move from the Bank of Canada, or are they more likely to wait this time?
It very much looks that way. Bank of Canada has not signaled otherwise, and the economy isn't that great, if I'm being honest. And even with this, work stoppage halted fairly quickly on the rail side. There's a bit of damage that comes from there, and the economy just isn't growing that fast. Anyway, that's its own story. Youth unemployment is high, and some interesting immigration changes recently. So plenty of sort of swirling developments there. But I would say rate cuts are appropriate for Canada, and it looks like the Bank of Canada is in a pretty good position position to deliver a third, probably a 25 basis point rate cut. You've got a little chance of a 50 price there too, but I think 25 probably is the more likely at this point, since we haven't seen a abrupt shift in the economic data for Canada. Interestingly, if I've got my numbers right, that I think is the first developed world central bank then to cut 3 times. We've had Sweden now do a second one, by the way. Canada has 2 right now. European Central Bank should do a second cut around the middle of September. All sorts of central banks have dipped their toes into the water, like the Bank of England and soon to be the Fed as well. But actually, Bank of Canada is a little ahead of the game there, and it does make sense to me. The economy is certainly weakening, and Canada has such a high level of rate sensitivity. And we were just revisiting some of the mortgage rollover data for Canada, and 2025, 2026 are pretty big years for Canada. 55% of all outstanding mortgages in Canada will renew or mature in those 2 years, and so that's a big chunk. And ideally, you do have mortgage rates lower. These are people who locked in at 1.5%, 2%, or something in that approximate range, and 5-year mortgages these days, and I'm just going to websites, and so I'm sure many of the viewers know much more than me, but they're 4.5 or four high or something for a 5-year mortgage rate, and so that is a fair-sized pivot and will be costly. So there's a certain urgency there, and so the Bank of Canada is just moving a little quicker than some central banks.
Yeah, and wage growth over the last 5 years would be nowhere near enough of a difference to make up that gap in disposable income if you end up with a mortgage rate that's 2% higher, or even if you
Right.
pay down the balance, then
Yeah.
factor in inflation on other products, you're in a worse spending position than you would have been in before.
Likely. I should say, actually, the math on that's a bit tricky. That's a really good question, Dave. I
Yeah,
hadn't
yeah.
quite thought through that angle. But so Bank of Canada has done some work. This is independent of monetary policy. They've done some research, kind of digging into the individual mortgage holders. And of course, there's floating rate and fixed rate and all sorts of
Sure.
different things. The math they did, it's a little stale, and at the time, the 5-year mortgage rate was a little higher, so maybe it shaved these numbers a bit lower. But they figured that the average Canadian with a mortgage coming due in that 2025, 2026 would see a 20 to 40% increase in their monthly mortgage payment. The 40% is more people with kind of floating rate stuff that really needs to adjust, and the closer to the 20% people with a 5-year mortgage that needs to adjust. I went down a rabbit hole, by the way, of mortgage. I have my own mortgage, by the way, I should admit, and mortgage calculations, and actually, it's quite confusing. It's not just that the math is tricky. I'm a little bit surprised by a couple of the underlying premises, which is I always thought that you owed a certain amount and it gets down to zero 25 years later. And of course, it's not a linear path to zero because you've got so much interest to pay at the start and much less. So it's kind of an accelerating path to zero. But I always figured that regardless of the interest rate, you would hit certain milestones. Like after 5 years, you would have paid off, 6% of the mortgage. And after 10 years, you would have paid off, 18%. And it kind of accelerates on. That's actually not the case. I was plugging in different numbers for different mortgage rate assumptions, and they left you with very different principals owing 5 years later. And so I'm told it's because, by the way, this is a total waste of space, I guess, on your podcast, but I'm told it's because they assume that whatever the prevailing 5-year rate is then extends over the rest of the lifetime of the mortgage. Right. And so that sort of changes everything. Whereas in my world, I guess I would assume you'd want to plug in some sort of normal guess as to what it should be, over the remaining years. But the bottom line was that, in my own head, I thought, gee, a lot of these mortgages, 2/3 of the payment is interest. 2/3 of the payment's going to double or triple, and that's going to be a crazy increase. And because it's not, because of some of that math I kind of loosely alluded to, that's why on the fixed rate side, it's more like a 20% increase. And so back to your observation, I think you're right, which is most people will struggle.
Let's just clear. A lot of people have mortgages. People are getting their calculators out right now as they listen and trying to. But like as you're saying, you have 3, 4, 5, whatever your term is. You've got that certainty, unless you're making additional payments. And then the next 20 years, say in a 25, that's just a projection. So that's going to
correct.
That's why your numbers are going to be
But they swing a little less than I would have guessed. But still, a fixed year might, Bank of Canada says, on average, be 20% higher when it renews in the next few years. I only hesitated because you said, well, wages haven't kept up. And I thought, well, they are kind of moving at 5% a year right now. And over 4 or 5 years, maybe they almost have. But of course, that's an unusual period of wage growth. And critically, expenses have gone up so much that it's not really a real increase. So you're probably spending that wage increase on something else. And of course, that's just averages. And many individuals haven't seen any wage increase over that period of time. So there certainly is some pressure mounting and an extra bit of urgency for the Bank of
Yeah, no,
Canada to
I
cut.
just threw that out because I knew you'd be looking for something to do on the Labor Day weekend. Since it's a long weekend this weekend,
Yeah,
you need a project. But I think that is some interesting analysis. I'm not surprised that the government or Bank of Canada has done some work on it, because the consumer is 70% of the economy, and where they're going to land a year from now, as all these mortgages are coming due, in terms of just how much money is there for people to spend,
yeah,
is something that that'll certainly have an impact on the economy.
yeah.
But maybe I'm overrating it, because again, you're just if you just say, okay, well, wages are up, mortgage up a little bit, prices up, but you add it all together, and perhaps
Yeah.
people are okay, as long as we're in a world where rates are a little bit lower than they are right now, and inflation has calmed down and normalized.
And unemployment doesn't keep rising, because it's been rising in Canada quite a bit. It's up 1.6 percentage points from its low already.
So let's let's see what we let let's see where we go from here. I mean, it's gonna be an interesting couple of years for the Canadian economy, and again, the lower rates
Mhm.
are certainly going to help if we continue along this track. Speaking of jobs, because this was an interesting one for me, and I don't know how many Canadians caught this, because they're not necessarily everyone's following business news and economic news the way you and I do, but all of a sudden, the Bureau of Labor Statistics in the U.S. Comes out last week, and this is a regular revision. I'm sure you're going to point us to how that this isn't that uncommon.
Mhm.
That there's an adjustment over the last 12 months in terms of the number of jobs that were created in the US economy, net jobs that were created, and they shaved about 800,000 jobs
Yeah.
off the numbers that we've done a podcast every month reporting those numbers, reacting to those numbers, and then it ends up that there's 800,000 fewer jobs than we anticipated. And it just kind of seems like politically, which is interesting, nothing. And markets kind of, they didn't seem to think too much of it anyway. So what are your thoughts on these
Mhm.
disappearing jobs, or jobs that just never did appear, but
I
we
did,
thought might have?
I did see Trump say some quip about it, so
Yeah, yeah, yeah,
so it did not go unremarked entirely. But you're
yeah.
right. 818,000 fewer jobs, and so officially, previously, I should say, between March 2023, March 2024, the U.S. had been thought to have created 2.9 million jobs. Turns out it was 2.1 million jobs. It's not a trivial difference. To reframe this, previously the thinking was that the average month had generated 246,000 jobs over that year. Now it's 178,000. So I mean, it's still fine, but it's a fair bit less, I guess, as you would guess when you're talking about 800,000 of almost anything.
Yeah.
So pretty big. I will say, just to kind of calm us down a little bit. So one would be, it was pretty expected. So every time this preliminary benchmark revision comes out every August, for the last number of years, it has been a negative number. So this isn't a total shock. I had seen some pretty smart sell side U.S. Financial institutions predicting numbers like 500,000 or a million. So like this was within the realm of what was
Okay.
considered possible. So not a total out of the blue outcome. Do note that this is the preliminary revision. There was a final revision in
Oh,
January, February, early next year. For the last 4 years, that has then reversed about half of the initial
oh, really?
adjustment. And so it could be that minus 800 becomes minus 400,000. We don't know that, but that's been the historical pattern. I don't know why, to be honest. The one that may be in particular being missed, and I was writing about this in my latest macro memo, I was kind of laughing a little bit about it. Not too funny when you lose jobs, but laughing just in the sense that they're missing something else, which is that the particular survey they're using to calibrate does a really bad job of picking up undocumented immigrants and unrecorded work. I guess, as you might guess, it's pretty hard to
Yes.
pick that up. And so the thinking is that that's probably been rising quickly given those numbers. And so I don't know that you could say therefore we're right back to zero, but I would say there are a number of forces that reduce it a little bit. The other thought, and I guess my plan here is to downplay this. I'm not sure why, but anyways, my other thought is, keep in mind these are revisions through to March. When we got scared about the U.S. job numbers, we were getting scared, and I'm losing track now, in July. And so this is not what this is prior to the slowdown. This is not suggesting that suddenly we are in something awful right now. It doesn't mean that we've miscalibrated the degree of the slowdown there. But at the end of the day, it's a softening labor market. If you want to see a silver lining in the softening labor market, actually weekly jobless claims have been getting a fair bit better the last few weeks. And so
Yeah,
that had been one of the
that's right.
signals that was deteriorating.
Sure.
It stabilized. But certainly, this isn't great for the job market, and job creation was weaker in the month of July. And we're going to get the August numbers next. I think we're going to talk probably. We usually do a podcast, don't we? We'll talk presumably in a week Friday or something like that. And so the thinking is it'll be an okay number, but that's going to be a pivotal one, because if we get a number that slips below 100,000 jobs for the month, that's going to be concerning. I think you could say a kind of a continued trend toward weakness that we're hoping stops, but hasn't so far. If it's 100 to 200,000, I think you say, okay, that's sort of the soft landing story. If it's above 200,000, you say, like, who cares about the July number? Clearly, it was the mistake, and we're perfectly fine. So there are a number of ways that could go, but that's going to be worth watching.
So, and it will be worth coming back to this podcast because this is the most important jobs report ever. So next Friday with
I'm going to be on remote
Eric
assignment, Dave. I'm going to be
Eric
recording
Lascelles.
from my Victoria hotel room when we do that at 5:30 in the morning or something. Anyways, we'll
Oh,
have
that's good.
a grand
I've
time.
recorded from there. Very very good sound. So expect
Oh,
Eric to
good.
be sounding good, talking about what could be a good or bad jobs report. We'll see where we go there. But again, I've got to think that the the, the, the Fed because it's nice for us to know, and it's nice for markets to know, an accurate number around jobs, and then we can do some additional analysis to say, maybe it's a bit too high an estimate or too low an estimate, and we'll get an adjustment, and we've gotten this adjustment. But I would hope the Fed has many more tools in their toolbox to make that assessment around the labor market than just that report every month to make the
That's true.
decision of when they're cutting or raising rates, right?
That's right. Well, I mean, at a minimum, there are a number of formal surveys like jobless claims and like the Jolt survey. There are other ones like that too. They can take a look at, and so yes, it won't be that one thing, but that is maybe the one single most regarded indicator. And of course, that day does release the payroll survey and the labor force survey. They do release a chunk of things all at once there. Certainly, the other one to watch, and we'll talk about this, I'm guessing, is the ISM Manufacturing Index. Really, the reason everybody panicked for a moment in early August was weak payrolls and weak ISM manufacturing. And then we had a bunch of things that came out since that we really haven't talked much about that looked just fine. ISM services, senior loan officer survey looked fine. Small businesses feeling better. Some consumer metrics looking pretty good. So we've had some things that look better. Now we want to circle around and say those two original bad things, are they still bad, or are they a little bit less bad, or where do they stand?
Yeah, and stay tuned for next Friday. But as we continue to remind the listeners, and I think this is one of the pieces that you get the most value out of listening to the podcast on a regular basis, is we're going to talk about what's happening in current markets, big picture, right down. We were talking about some individual earnings reports with Stu Kedwell on different episodes with him, but we can we know what we're trying to accomplish long term, and that's the focus we want to have from an investment perspective. Knowing what's happening short term allows us to sleep at night and understand that we're what we're trying to accomplish long term, and whether we're on track, and recognize where some opportunities are created by markets. If we look at that scare around the jobs report and the ISM number that Eric's talking about last month, really created a nice opportunity. Or if you were a dollar cost averager and you had your monthly contribution going in at that point, or you accelerated it forward, you were able to take advantage of that, and that will benefit you long term. Long term, though, and really long term has been the last 30 years. The Chinese economy has been the primary or the major contributor to global growth. And we've talked about China. We check in on China from time to time because of the importance of that economy. When you look at that economy right now, Eric, because I know you spend a lot of time looking at China, where do you think China sits today from an economic perspective?
I mean, it's I mean, the optimistic statement would be it's the biggest the economy has ever been. Of course, that's the state for almost all economies, but
Yeah.
it's moving much less quickly than usual. And so, we did grow accustomed to a China that could grow real GDP at 10, then 8, then 6% a year. And these were really, really fast rates. And, it's almost like compound math. You can double the size of the economy remarkably quickly, every decade or faster when you're growing that quickly. And they've slowed. And we always knew they would have to slow to some extent because no country continues to grow that quickly as it gets rich. And some of the growth they were enjoying previously was on the back of some maybe unsustainable trends like a housing market boom that can't last forever. Canadians know a little bit about that. And so it made sense that it slowed. The economy, despite those challenges and with still a profoundly weak housing market and some, unenthusiastic consumers, if we're being honest, it is still tracking about 5% real GDP growth this year. So it's not quite the full-on disaster that people think. And their exports have been good, and they've sort of pivoted back toward manufacturing and industrial production and some of the things that they're historically good at. And I guess, the hope that the consumer would grow and come to dominate the economy is sort of put off for the future a little bit, or isn't driving quite as much as they would have liked. But they are tracking 5% growth. We do think that slows. We've said for quite a while we think they're going to settle into a 3 to 4% GDP growth rhythm, which again is half what they pulled off a decade ago. It's a real deceleration. But it's still enough that China will be growing faster than any developed country, really, of note, at least on a sustainable basis. And our math would suggest, just because China is such a big economy to start with, that it's set to drive about a quarter of global growth going forward. And so China is diminished, and it's no longer the only place that can grow quickly, and it can't grow as quickly. And in terms of long-term challenges, of course, the demographics have turned. Their population is shrinking, and that's its own challenge. And housing is not at all a source of growth right now. And of course, frictions with the US. I mean, I would say one of the more pivotal moments for China will be which candidate wins the election, because of course, Trump is proposing some pretty aggressive Chinese tariffs, which would be consequential. Do note China's exports to the US are surprisingly tiny share of China's GDP, like it's 2 or 3% of GDP. So it's not kind of the end of the story. We actually double checked the numbers. I was so suspicious of them when we had them. I said, how could this be? But that, China is like the US. It's a very big domestically oriented economy. So trade is, I'm forgetting if it was 20% of the total or something. And then, the US just happened to be X percent of that. And that's how you get there. But certainly, there are some challenges that exist there. And, we haven't loved the way that the state has been given sort of preferential or preferences over the private sector, all sorts of things are, we think, limiting Chinese growth. We still end up with a 3 to 4% growth rate. And I always try to remind myself that Chinese policymakers have been probably the most competent economic policymakers in the world over the last couple of decades, and they are not encumbered by politics and things like that, and they can afford to take a long view. And they don't get it right every single time, but I would still bet that they do manage to stabilize the housing market and avoid the kind of debt crises that some people work about. And so I'll leave to people smarter than me whether that makes Chinese equities a buy or not, and how all that fits together.
Sure.
But the bottom line is that it's a challenging time for China, but China is still a world power, and it is still growing.
Yeah, and we're going to get somebody on to talk specifically about Chinese stocks. Again, your view is the Chinese economy.
Mhm.
Are they in a position right now in terms of the government? And again, it's direct drive economy, so like you say, no politics. They decide what they're going to do it, right? They don't have to worry about being going to the voters really to decide whether they get another term or not. But are they inclined right now to try and stimulate the economy, or are they just really trying to stabilize things at this point? Where's policy right now?
Yeah, that's a good question. I mean, I guess, I might give you both those answers. And so I think that they are in a position where they're trying to do some stimulus in an effort to stabilize housing, if that makes sense. So they are
Okay, all right,
providing support, though, is kind of the goal
sure.
here. I don't think anybody wants housing to be off to the races again, but the goal is to get housing on a better track and deal with some of the issues there. And indeed, they've been cutting rates, and I'm losing track. I've got a big long list, but they tend to do sort of incremental things. It's usually not a, hey, tax cuts for everybody. It's usually more of a, we told this bank to lend more to builders or something like that, and you have to kind of sniff it out over time. But they're doing things like that. They are very much trying to stabilize. I think they told local governments they could Is it lend to builders more? So anyways, things like that. And so yes,
Yeah.
they are doing some work to that effect. And so well, hopefully they pull that off, and I think there's a fair chance that they do. On the policy side with China, maybe the concern is just when you have a leader in place for an extended period of time, it can over time become a bit more of an echo chamber and get a lot of yes men and women around you, and it maybe the risk of bad policy decisions grows over time. But so far, China's been doing okay.
Yeah. Well, Eric, thanks for popping on. This was designed to be a quick visit, but as usual, a quick visit turns into a half an hour like nothing's happening because you always have so many interesting things to say. But thanks for always being available, and we'll see you next week for that critical jobs report.
Absolutely. Thanks, Dave. Thanks, everybody.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.